There is a corner of finance that has quietly grown into one of the biggest lending markets in the world, well over $1 trillion, and most everyday investors have never heard of it. It is called private credit. It does not trade on any exchange. There are no daily prices on your screen. And yet your pension fund, your insurer, maybe even your retirement account may already be lending into it. So here is the question worth a few minutes. What exactly is private credit? Why did it explode? And why are sober institutions calling it the next thing to watch? Start with the mechanism. Private credit is simply non-bank lending. Instead of a company borrowing from a bank or issuing a public bond, it borrows directly from an investment fund. 3 features matter. The loans are usually floating rate, so the interest the borrower pays rises and falls with central bank rates. They are illiquid, meaning the lender plans to hold them until they mature, not trade them. And crucially, they are not marked to market every day the way public bonds are. The value on paper can sit perfectly still while the world around it moves. Why did it grow so fast? After the 2008 financial crisis, regulators made it more expensive for banks to hold riskier mid-sized company loans. So the banks stepped back. At the very same time, big investors, pensions, insurers, endowments were starved for yield in a low-rate world, and private credit offered more. Capital flooded in to fill the gap the banks left. A market that was a niche became a giant, growing into the range of $1.5 trillion. The lending did not disappear. It just moved somewhere with far less daylight. And here is the catch. Part of why private credit looks so smooth and stable is precisely that it is not priced every day. A loan that would be wobbling on a public exchange can look calm in a private fund because no one is forced to reprice it. That can be a feature in a panic, or it can hide a problem. Meanwhile, floating rate loans cut both ways. When rates rose, borrowers' interest bills jumped, squeezing weaker companies. Watch for one tell in particular: payment in kind, where a borrower pays its interest with more debt instead of cash. A little is normal. A lot, rising fast, means borrowers are running short of cash. So, why should you care? Because of who the lenders are. The money funding private credit comes heavily from pension funds and insurance companies, the institutions that stand behind retirements and policies. When they allocate to private credit, ordinary households are, indirectly, the lenders of last resort. That is not automatically bad. The loans can perform well and pay handsomely, but it does mean a market most people can't see is connected to money most people are counting on. So what is the honest test? Not a prediction, a checklist. Watch default rates among the borrowers. Watch whether payment in kind interest is climbing, the sign that cash is getting tight. Watch whether private marks start touching down to public markets in a downturn. And watch for redemption gates, the moment a semi-liquid fund tells investors they cannot pull their money out on demand. None of this is a forecast, and none of it is advice. It is a framework. The point is simply to see a market that was built to be hard to see, and to know which dials actually matter.